Hello everyone, hopefully you can hear me okay. Welcome to this webinar, Building a Cash Flow Forecast for Beginners. Just to introduce myself, my name is George Smith. I'm the Managing Director at Cameron Computers for the HPP systems customers on the webinar. We're the sister company down in Peterborough. But my background before joining Cameron was working in accountancy. I'm a chartered accountant, so have a bit of background in financial reporting and do some of these things for ourselves, and this is something I've been working on for us as a company during the last month or two during the disruption, making sure our own cash flow is in a good place. So I thought I'd spend half an hour to an hour sharing some of the fundamentals and some of the processes I've been through that hopefully you'll be able to take away from this. Obviously, you're all different types of businesses, of different industries, different sizes. You sell and buy in different ways, so it's certainly not a one size fits all this, but like I said, hopefully there'll be a number of principles in there that you can take away. And then at the end, we're going to do a Q&A session. You should be able to see a Q&A option in your toolbar where you can ask questions. So if things come up during the session that you think of, you can ask the question. Rachel's on the call as well, who's reviewing them, and then at the end we'll work through them and answer them. I'm also available after the session if anybody wants to follow up on anything that thinks more specific to them, or if something they see here doesn't think a fit, but how would I suggest it was tweaked for them. So most of this session is going to actually be a bit of more of a workshop style. I'm going to go through a forecast I've essentially made up, but hopefully we'll demonstrate a number of those principles. But in terms of an agenda, just before we start, just to make sure, if you can't hear me, you do need speakers or headphones. There's no option to sort of dial into this. So if you're wondering if you can't hear me and you're stressing about that, it'll be because you don't have speakers on. So you need to get them sorted on your device. But in terms of an agenda, I'm just going to start reflecting on the importance of cash flow. The fact that you're all on this webinar obviously indicates it's something on your minds and something you're taking seriously. What's great, and during these periods of disruption and challenge, it does concentrate our mind on cash flow. But regardless of that, during the good times and the bad, cash flow is absolutely fundamental to a business. So I'm just going to reflect on some of the important aspects of that, and then just a few of the, like I mentioned at the start, the underlying fundamentals and principles that should apply to any cash flow forecasting, regardless of your industry, regardless of the nature of your business. And then, like I said, I'm going to spend most of this session actually working through it in Excel, as accountants love to do, go through a bit of a forecast that I put together that will demonstrate some of those fundamentals in a bit more detail. So why is cash so important? You've probably all seen this quote before. It's a very well-known quote, and there's a reason for it. It's very true. Revenue is vanity, profit is sanity, cash is reality. I think a lot of us are pretty aware of the first 2 points there, that revenue doesn't always translate to success and profits, and people understand the importance of profitability, of selling things at a profit and being able to manage our overheads. But where I've seen businesses get unstuck more often than not, it's not from the profit point of view, it's from the cash point of view, because cash is so important to meeting our obligations, and far more than that. Yes, cash allows us to meet our obligations and pay our suppliers on time, pay our staff on time, but it allows us to do a lot of other things. It allows us to capitalize on opportunities. Over the next 3, 6, 12 months, there's going to be some challenges for all of us, but there's also going to be some opportunities, and it'll be the businesses that can make the most of them and react to those changes and those opportunities that will do the best. But to do that, you need cash. You need to be able to invest. You need to be able to make moves in your market, and you can't do that without liquidity. It's also worth pointing out that obviously cash is something that can be distributed as returns. People are in business to make money. Shareholders, whether you're a shareholder yourself or you're working for shareholders, the way our economy works, the way everything we do works, is to enable returns. So ultimately, that cash balance is vital to driving business growth and the incentive to grow businesses and invest in businesses in the first place. So in summary, for me, cash ultimately determines whether we survive or not, whether we manage to pay our suppliers and our people on time and keep going and pay HMRC and everyone else. But it also determines if we can go beyond that and thrive, and that's where that link to making the most of opportunities is. So, like I said, the fact that you're all on this webinar and you're thinking about cash flow management and where your cash balances are, it indicates that you're onto this. But I think it's worth reflecting on at the start before we delve into a bit of the detail. So the fundamentals, and after this slide, pretty soon we're going to jump into to the actual forecast. But I just want you to be mindful of these points all the way through what I'm talking about. The first one is decide on your timescales, and by timescales, I'm talking about frequency and length. So frequency, are you going to be trying to forecast on a monthly basis, a quarterly basis, a weekly basis? 9 times out of 10, I'd probably say weekly's fine. You're probably doing your monthly's fine. You're probably doing your financial reporting, your management accounts on a monthly basis. You're making decisions on a monthly basis, and that's probably fine for normality. What you may want to do is look at the next 3 months on a weekly basis. If you've been particularly disrupted by what's going on at the moment with COVID-19, with some of the sort of erratic impact it's having on businesses, you may want to look at that on a weekly basis. But when we start looking at this more in the longer term, medium long term, monthly's fine for most businesses and should be able to at least flag up any problem areas, any months where it's going to be tight, and then you might want to delve into that particular month in a bit more detail. And length, again, I'd say you want a minimum. You want to be looking 3 months in advance, but really, if you can get to a 12-month forecast, beyond that, unless you've got some really strong sales forecasting in place and you've got some good process in place that you can really plan further, there's not too many benefits of planning more than a year in advance, I'd say, in most cases. So we're looking at frequency of monthly, potentially weekly, if you've got any problem areas, or if you think the next sort of quarter might be particularly problematic. And then the length of this forecast, I'd go for 12 months. It seems obvious, but I put it on there. Identify your inflows and your outflows, so the money coming into the business and the money going out of it. And that's where we're going to spend quite a lot of time, to be honest, of identifying the types of them. But don't just think sales, costs, overheads. There's more to it than that, and we're going to go into that. But one of the first jobs you're going to have to do is write a long list of all the inflows of cash into your business over the next, let's say, 12 months, and all the potential outflows. And then what we're going to have to do to them is apply timing, and the timing is crucial, because when we go into my example, and I have over exaggerated it for the purpose of this, but what you will see is this made up business has got a larger cash balance at the end of the 12-month period than it has now. What's great, but the periods during the next 12 months where, because of the timing of inflows and outflows, we have cash flow problems, and we're going to have to take action. So you really need to be as accurate as you can with the timing of these inflows and outflows, and putting them in the right week or the right month, because that's where it's going to flag up the issues. It's not just saying, oh, over the next 12 months we've got enough cash. If there's a problem in the summer, if there's a problem in the winter, then that needs identifying straight away. Allow for sensitivity, and I'll touch on this and show you some examples of this when we get into the spreadsheets. But this is a forecast, and it'll support my next point as well. And you can't get this perfect. You can't know everything more than ever at the moment. There's a lot of uncertainty for all of us and for all businesses out there. So one of my biggest recommendations is, whatever you forecast over the next 3 months, 6 months, 12 months, build sensitivity into that. So say, well, what about if I'm 10% wrong? And I'll cover some of the things that you might be wrong with, but we want to always be thinking about any inputs that we're putting into this forecast. Can I flex that a little bit? So then when I'm making decisions, or if I'm delivering it to other stakeholders in the business, I can say, look, I think we're going to be okay, but we've got 20% of wiggle room on sales volumes, otherwise there's going to be a problem. So you can just start to give yourself a bit of variance and a bit of room for maneuver with these forecasts. And then that's final point, balance accuracy with suitability. Like I said, we're all businesses of different sizes. We've got finance teams and accountants of different numbers in terms of the size of our teams. Maybe at the moment you're down to one person. Maybe you don't have an accountant in the business at the moment, and you're doing this for the first time yourself. So yes, it's really important that we're as accurate as possible, and those fundamentals I mentioned there are followed. But it's got to be usable, and it's got to be something that you can actually complete. And there's no point spending 6 months making the perfect sales forecast to find out you run out of money by then. So be pragmatic with this. And again, when we jump into the spreadsheet, you'll see where I've made assumptions, and I've tried to be reasonable with them. I've tried to use the information I know now, but always try and balance that sort of accuracy with suitability. You're going to have to accept that you won't be able to perfectly forecast your sales for the next 12 months. So let's make some assumptions, let's make some reasonable judgments on that. So just before I jump into the spreadsheet itself, because not all of these are included in my example, I've just quickly identified what I see some of the main inflows into your business. So one of the things you can do after this is go away and think of any of these are going to be relevant to you over the next sort of 6 to 12 months. So I'm sure you've all got sales already written down, and we're going to spend a lot of time on that. Don't get me wrong, it's probably the biggest inflow you're going to have over the next 12 months. But there are a lot of other areas where cash could flow into the business. So loans and finance, if you've got any loans that you could take out, that you're planning to take out, are you going to use the government's bounce back loans or anything like that? Because that is an inflow of cash into the business right now. So we need to be identifying that in our cash flow. Same with grants, and they're not going to have an outflow in the future, so they're even better. So have we got a disruption grant? Have we got any other sort of non-COVID-19 grants that we may be able to claim and get cash into the business? Investment, if you've got shareholders that are planning to put more cash into the business, then that needs to be recognised, because that will count towards our cash flow. Sale of assets, so you may have some significant assets. You may be planning to purchase some more assets. Does that mean that you're going to be selling some more assets? Because if this can be some quite significant numbers depending on the nature of your business, depending on how much you typically invest in capital and fixed assets. But if you're going to sell any of them, that's cash to recognise, so we'd want to recognise that in there. I've then got refunds and rebates. Again, depending on the nature of your business, there's some businesses that work on based on sales volumes or hitting certain figures, they're going to get rebates or refunds back from their vendors. We can factor them in. And then finally, a bit of more of a broader one at the moment that potentially crosses over with loans and grants, but government support, things like furlough and any of the bounce back loans or any of the grants that are available, anything like that, we want to be including and identifying when we think we're going to get it, because they're all valuable inflows for our business. And maybe more depending on what sort of business you're in, but I think that covers a lot of them and gives you a nice checklist to start with, to start either thinking about yourself or asking people in your business, can you think of any of these in the next 12 months that I can factor into my forecast? Outflows, this is unfortunately a longer list normally, but I've summarised here. So the big one that matches your sales will be your cost of sales. So these are the costs directly attributed to what you sell. So if you sell a product, this is the buying of those materials or the buying of that stock so you can sell it. Salaries, probably the second biggest, if not the biggest aspect of your outflows for a business. And this is one that obviously is going to have a big impact on your cash flow. It is something that you can normally forecast with relative accuracy, particularly in terms of timing. But even still at the moment, these aren't normal times, and people's sort of run rate of salary is fluctuating like quite a bit. So you're going to have to think about that in terms of furlough, how many people have got in the business now, what it's going to look like in 3 months, 6 months. If you've unfortunately got any redundancy costs that may have to be factored into this. All of that needs covered within the salaries, the wages, the people side of things. Capital investment, this is the flip side of selling any assets. Are we going to have to purchase any fixed assets? And this is one of the, when we get onto sort of that difference between profit and cash, this can be one of the biggest differences. And I'll spend a bit of time on this when we get into the spreadsheets. But if you've got to make some significant investments in in capital expenditure, so equipment, machinery, IT infrastructure, anything like that, if that's required over the next 12 months to allow you to function and grow as a business and do everything else you want to do, you need to recognise the cash that's going to go out there. As I'm sure many of you'll know, normally that would go on your balance sheet and you depreciate that over time through your P&L, but from a cash point of view, unless we're going to look into leasing and finance that again I'll discuss later, all that cash is going to have to come out within the year, so it needs recognising in the cash flow statement. Loan repayments, so yes, we can recognise loans coming in, but at some point we're going to have to pay them back, so loan repayments are going to have to be factored in, and any associated interest. Then you start getting into things like rent and utilities, and all your other general overheads. And like I said, I'm going to spend quite a bit of time on this, so I won't dwell too much at the moment. And then HMRC liabilities. There is a bit of flexibility in this at the moment. Normally it'd be a very certain thing that you'd be able to forecast, but obviously government have given us more flexibility on payment of VAT, payment of corporation tax bills, but ultimately it is going to have to be paid out. So you need to start thinking about that now. And again, I'm going to jump into that during this workshop. So I just thought I'd summarise some of those key inflows and outflows, because I won't be able to cover them all in the working example I've got, but hopefully that gives you a starting point in terms of inflows and outflows to use that as a checklist to start in your own business. So hopefully now you can all see a spreadsheet. So I put this together. Like I said, it's not pretending to be a complete cash flow forecast that you can just run away with and use yourself, and it's not going to apply to every business, but I've tried to build it in a way that demonstrates a lot of those principles. So the first thing we're going to have to do is I think start from what's going to drive our cash flow forecast, and two of the biggest things are going to be our sales and our cost of sales. So I'm going to start with the sales. The first thing we need to do is do some product analysis. So what I've done here is I said, look, I sell 5 products, 5 widgets, and I've identified a sales price and a cost price for both of those. Now, things we need to think about here. So first of all, depending on the nature of your business, it might not be realistic to do this by product. You might have 10,000 product lines. You might have one product line, I don't know, but what you need to be looking at is a sensible way that you can either group your products or identify your products and identify that sales and cost for each one. If you're going to do product grouping, that's absolutely fine and sensible, but what I'd say is look for commonality between the sales and cost price and also your expected volumes, because those 3 things are going to drive a lot of this cash flow forecast. So if you've got a product group where you sell it for roughly the same, you make the same margin on it, and you really in your normal reporting and from your forecasting point of view, you'd plan that the volumes that you sell as an overall and then group that together. But you know, it might be that you can just have one forecast here, one product line, one revenue stream, or it might be you're going to have to do quite a lot of work here because you've got significantly different product types with different margin makeups and volume forecasts. If you don't do this at the moment, I think regardless of cash flow forecasting, it's a really useful exercise to do. So this does take a bit of time to get to this product analysis stage. It's something you're going to be able to use in a lot of other reporting. I've done sort of sessions on product mapping before, where you look at sort of revenue versus contribution and which products are making the most for you with the least effort and stuff like that. So there's some really useful takeaways that you can get from product analysis. So I'd recommend it being done regardless of the cash flow forecast. Other points to make on this: when we get to that sales price and cost price, remember this is for the purpose of a forecast, so it's what we are expecting to sell it at during this forecast, what we're expecting to buy it at during this forecast. A good starting point is history and looking at maybe your average selling price and your average buying price over the last 12 months. Something you should be able to get from your finance system. That gives you a good indicator, but be prepared to amend it or adjust it if you fully forecast there's going to need to be that. So if you're expecting that over the next three months I'm going to have to sell at a bit of a discount to make the volumes I want to make, then recognize that here if you can. If your cost prices are fluctuating all the time, then take a 12-month average, it is a forecast. You don't want to spend forever and ever trying to get an exact cost price that you're never going to actually be able to reach. So use averages if you can, and then try and adjust for them with what you think is the best, most realistic forecast. So once you've got that, once you've got, right, these are the products I'm forecasting, this is what I expect to sell them at, this is what I expect to buy them at, then we can move on to volumes. I will make a point now that I understand that this is just a way of doing business, where you're selling physical products perhaps, or services, and not everyone's in a volume-based business. I think if there's anybody who's not in this sort of business model, you just need to think about how you report. And I'll share with you how I've done HPP and Cameron's cash flow forecasting. So we're not really in this sort of model, even this is more common, so I've used this as a model. We have a renewals base where we're invoicing customers for support and services on a regular basis. So we've done a renewals forecast when we know when people's contracts are up for renewal, so we've been able to build a forecast based on that. And then on top of that, we're really a projects business. So we've done it we've done our forecasting on a projects point of view. So how many server infrastructure upgrades do we expect to do each month for the next year? How many new account systems or upgrades do we expect to do over the next 6 to 12 months? So if you're in a different type of business, then be flexible with what you do. But what we're trying to get to is a sales forecast, and this is the most sort of common method that's used at most businesses, and looking at the list of attendees seems to fit best. So I just thought I'd make that point, that if you're thinking, well, we don't work in this type of business, then there's other ways to do this, obviously, but I'm following this process for now. So once we've got our sales price, once we've got our cost price, we can then start to put some volumes in place. You can see I'm doing this on a monthly basis, so I haven't split down by weekly. Monthly is fine for this purpose. And then for each product, I've thought about how many I'm going to sell over the next 12 months. Now, a point I make here, so really challenge either yourself or whoever's providing you with this information, particularly with where we are at the moment. It's no point doing last year's sales divided by 12 and just spreading that out, because are there going to be any impacts, positive or negative, from what's happening at the moment? And then how much impact do you think that's going to have? Is it going to be a gradual increase back to normality? Is it going to be, actually, I can't sell anything at the moment for the next 2 months, but then I expect things to go pretty much back to normal, so it's going to be a sharp uplift? You can see here I've gone for more of a gradual increase with some of these products, whereas this one, for whatever reason, I can't produce or sell that one at the moment, so I've got 4 months of not being able to sell it, and then product 4, and then I can get back to selling it in month 5. So this is going to have to, this is a forecast, this is an estimate, but use all the information and people in your business that can have input into this, because it's going to have a huge influence on that cash flow forecast when we get to it. So really challenge yourself or people in the business to get this as accurate as possible. The next point I wanted to make on this is around sensitivity, and this is a good example where you could put some sensitivity and flex into it. There's no reason you couldn't put flex into it with your sales price if that's something where you think there's a risk or quite a bit of uncertainty, if you're not sure how much discount you're going to have to apply over the next year, for example. But what I've done is said, look, I've done my forecast best I can, but what's actually going to drive my forecast is this second table rather than the first one, where I can quite easily just change my sensitivity to say, well, what about if I'm 15% wrong? What about if I'm 25% wrong? And then that'll drive the rest of this forecast. So yes, my sales director said he thinks I can sell 200. Well, what about if he or she is 15% wrong? Well, then we can see. So when we get to that cash flow forecast and we maybe see some of the tight areas, I can see how much wiggle room I've got. And like I said, you can apply this sort of approach to all the key drivers within a forecast. So I'd say wherever you've got significant material uncertainty, build in some sensitivity. So you can start reporting with parameters to say we're 10% comfortable on that or more. So all this is doing is allowing me to easily recalculate everything every time, updating my volumes based on that sensitivity. So what the next section does is pretty much just a bit of simple maths of timesing up my expected sale prices by my expected volumes. And that's going to be a key component of the forecast once we jump onto the next tab. Here's a really important part, and when I spoke about timing in the fundamentals, this might not be significant to your business, but you need to think about the difference between when you're invoicing and when you plan to sell something and when the cash is going to come into the business. So if you're in a B2B business selling commercially, you're probably giving your customers some sort of payment terms. Do you think those payment terms are going to be honoured exactly over the next 12 months? Or do you think maybe that on average it's going to take you 2 months to collect your debts in? If you think there's a significant difference between when you sell and invoice something and when you're going to collect it, then it's this one that should be driving your forecast. So in this case, I've said, well, when I invoice something, product 1, 17 grand's worth, I'm not expecting to collect that to month 2. So I've almost staggered all my sales by 1 month. So again, going back to our business, we've done something similar with our renewals. The month we invoice them, we give people 30 days. So I've almost knocked back all our renewals 1 month to recognise that we won't get the cash for them for a month after we've invoiced. So that's another good example of that difference between profit when it goes through your accounts and from a cash point of view when it hits your bank account. So again, depending on the nature of your business, you might need to actually spend quite a lot of time here. You may need to do some debtor days analysis to look at your average time of collecting debts in. So if you just do a simple with your year-end numbers or your month-end numbers, if you do your debtors divided by your sales times 365 or times 30, if you're doing it on a month's worth, that'll give you an average feel for how long it takes you to collect your debts in. That could be one of the most significant things for some businesses over the next 12 months. This part might not be the problem of selling. It might be more about the collecting. So again, really challenge the business or yourself on that part and drive it by when you think you're going to collect the money, not when you're going to invoice for it. So then we get onto the flip side of that. Yes, we're going to sell all this stuff, but we're going to have to buy something to sell it with. So I've done a cost of sales. Again, this is just driving that unit cost price by my volumes, and then that gives me a cost of sales forecast. So this is a direct cost attributed to those sales. So I'm not getting into overheads here. I'm not worried about salaries or anything like that. It's if I'm going to sell widget A, I need to buy component 1 and 2 to enable me to do that. So that's what needs to go into this element of the forecast. So again, that's just a simple multiplication table. And what I've done here in step 4.5, I've thought about, again, what makes an influence on the cash point of view. One of those things is going to be lead times in terms of, do you need to buy things significantly earlier than when you sell them? So if you've got, if you want to sell something in month 3, do you need to buy that in month 1 to allow you to prepare it, manufacture it, whatever it might be? Then you're going to have to adjust again, because this is all driven by when you're going to sell it on the left hand side. This is when you're going to pay for it. So this is when it's going to flow out the business. So potentially something that you sell in month 3 that you collect the money for in month 4, you might have had to pay for in month 1. So we need to recognize that difference, even though, again, from an accounting point of view, you're going to potentially accrue and recognize things in the right months. That's fine. But from a cash flow point of view, it's when it comes in or out of your bank account. So I've looked at lead times and also credit terms that hopefully will be in our favor that would bring that credit forward. And in this case, I've said actually they offset each other. So yes, I need to buy it a month before I sell it, but I'm going to have 30 days to pay for it. So it will mirror effectively the two tables. But what it does do is it creates an out of step for me where from a cash point of view, in any given month, I'll have to pay for it and I won't get paid for it for a month later. So I do have a difference between my months in terms of my cash inflows and from sales and my cash outflows from cost of sales. And again, depending on the nature of your business, you might have to spend quite a lot of time on this area and thinking about this, particularly that lead time between you paying for something and it being available for sale. VAT, so I haven't mentioned this yet. What I've done in this case, assuming most businesses on this call are VAT registered. I've gone on the basis that this is all gross and including VAT, all these numbers. So what I've done here is basically calculate my VAT liability, my sales costs, what's the VAT element of them, because that doesn't mirror a cash flow point of view. Obviously, we recognise VAT liabilities as we accrue them, but when we get to the cash flow forecast, I'm probably paying my VAT liability quarterly or annually, monthly, or whatever it might be. So I've separated out the VAT element of all that, so I can plot that differently in my cash flow forecast. And again, strange times at the moment. Normally this is something that's very predictable. We have been given flexibility on our VAT payments in the upcoming months, so you may be able to stagger that VAT payment and help your cash flow over the summer. So it is worth splitting out at the moment if you've got significant VAT liabilities. So what I've done there is a bit of prep really for our cash flow forecast, concentrating on two of the biggest inflow and outflows that I'm going to have, which is my sales and my cost of sales. Like I said, if you're not in a volume business or you're not in this sort of business, you're going to have to think about how this translates to you. You're in a project business and you have to do project forecasting. If you're in a service business, then maybe you don't have many direct cost of sales, and it's all going to be about the salaries that we'll touch on later. But hopefully this translates to a lot of companies and you can use a number of these principles. So now we've got that on a monthly basis, what we think is going to come into the business and what's going to come out from a cash sales point of view. And then we can start looking into the cash flow forecast. So the first line is pretty simple. That's coming directly from my sales forecast, but based on the month delayed. Obviously, I'm pretending this business is almost just starting, so to show what that delay might look like, and I've got no sales. I'm sure you'd always have some sales in month one, but maybe they're particularly low at the moment and they're going to be coming up, they're going to be increasing over the coming months. So it is relevant that's stepping of sales to cash. So we've got our forecast sales. I'm then taking a loan as well in this business. So I've got a nice handy 500 grand loan that's going to be paid out to me in 2 months' time. So that is a cash inflow into the business. And then I've got other cash receipts, but remember, going back, there's lots of different things that could be coming into the business. Investment, in this case it's a sale of an asset, because when we get a bit further down you'll find out that I'm spending some significant money on assets. So this is going to be the sale of my old machine, because I'm going to be buying a brand new one for a lot more money. But that's pretty quick to do, pretty simple to do. We've actually done a lot of the legwork on the initial tab. And now I've got a good idea of cash that's going to be coming into my business. Remember, if I change that sensitivity on the volumes, then that'll just automatically update that, so I can get a feel for how my inflows will change if I'm 10% down on sales per forecast. And then, like I said at the start, unfortunately, we tend to have a lot more outflows than inflows from a variety point of view. So one thing I would do here, something I did, is go into the finance system you're using, whether it's Opera or Exchequer Sage, and run a nominal report, a general ledger report, trial balance, whatever you refer to it as, and run through that full list of all your overheads and expenditure, and mark them off to say, is this something I need to consider, yes or no? So there's our cost of sales. We've already done the work on that. We've already calculated that. Our wages and salaries, undoubtedly you're going to have this, so identify them, consider things like furlough, consider things like if you're in a sort of business that works on overtime and flexing that up as you get busier, hopefully over the next few months as things start to ease off, see that coming in. So you can see my workforce is essentially growing as I'm allowed to produce more and sell more. Depending on how you got furlough set up, hopefully you can pretty much get that to match with your wages and salaries. So there's not going to be a significant difference between money going out of the business and furlough coming in. I know they're paying it within 3 days of a claim, so hopefully you're in a business where you don't have to necessarily split that out too far. Things like commissions. So we work in a business with a sales team that earn commission on projects. So if we're going to forecast more growth and more sales into the future, don't forget about costs that will be associated with that other than the direct sort of cost of sales. So things like commission Start plotting them now and when you're going to have to pay them. And then I've used rent as a good example of one of these timing ones. So everyone's got different commercial arrangements, everyone works differently, but rent's a fairly common one where you're probably putting it through your accounts monthly and either accruing or prepaying, depending on what you've got set up. But from a cash flow point of view, it's fairly common we pay rent quarterly or annually, and a few other things, insurance, your IT support potentially, these sort of things. You need to understand when the cash is going to flow out, because you're used to just releasing that gradually over the year, what's absolutely spot on from an accounting point of view, but from a cash flow point of view, all these things you need to say, yes, does that have a cash impact? Yes, it does. When's that cash going to come out of the business? So in my case, I pay my rent quarterly in lump sums, so I need to be putting it in when I'm going to be paying my landlord. Because when we look later down, these ones could be the difference that actually flags up problems for us. Again, utilities is a common one where you probably build quarterly and you accrue throughout the quarter and then get your gas and electric bill. Well, it's going to have to be paid in one go. So if that's the case, represent that in your cash outflows. Another one, insurance, often an annual payment. So find out when that's going to be and put that one in. So running through these are typically down to sort of the shipping and transport, your overheads, and this could be a very long list, it could be a short list depending on the nature of your business, but you want to be going through your accounts and identifying every one that you think is a cash overhead. Things that aren't cash overheads, things like depreciation, probably the most common one. That's an accounting charge that's made up from a cash point of view. So you disregard ones like that because we're going to consider them when we talk about capital purchases and sales. So you don't need to add things like that because there's no cash impact of depreciation. So I've got my VAT here. So this was my VAT that I've calculated on my direct sales and cost of sales. And then I've done a quick VAT calculation on my other overheads that are going to have that on them to work out. Again, I'm paying on a quarterly basis when I'm next going to pay VAT. So all of this is gross. This is the cash, representing the cash going out of the business and into the business. But then on a quarterly basis, I'm going to have to pay over to HMRC a lump of cash. So that needs factoring in. And again, it's more important than ever with if you are doing any sort of changes with HMRC, got any arrangements to delay your next VAT bill, that's going to have a significant impact on your cash flow from a positive point of view at the moment. So show it in here and make sure it's represented. Corporation tax, obviously another large one. So if you've got last year's corporation tax bill looming, if you haven't organised to delay that or anything like that, that's not something that's going through your accounts on a regular basis, but think about those because it could be really significant one-off or just a few payments throughout the year that'll have a big impact on your cash flow. And then that loan that I took in at the start that was great and boosted our cash flow, I'm going to start paying it back in month 7. So I need to start representing that and showing that in my cash flow forecast, because and that's going to represent any interest I'm paying, not accruing, but paying, and any capital repayments I'm making on that loan as well. So start to plot them out and put them in based on whatever arrangement you got with your bank. And then finally, in this case, I've got a capital asset purchase, so I'm buying some equipment. So that's where that came from, that I'm going to sell my old kit once I've bought my new kit. And in your account, you put that, like I said, you put that on your balance sheet and you depreciate that over 3 years, 5 years and release it against your profit. That's fine. It works similar from a tax point of view, but from a cash flow point of view, if you're going to pay cash for it, it's going to flow out the business. So you need to be recognizing that when you're going to pay for it. I'm doing a webinar next week on some of the practical things we can do to improve cash flow or manage cash flow. This session's all about finding out where our position is and almost then the next stage of, well, what can I do about it if it's not looking good? And one of the common things is with things like capital purchases is financing them and spreading those costs to more mirror the depreciation. So I'll touch on that more, but in this case, I'm paying a lump of cash for this, so it's going to come out my bank account. And then we get our total cash outflows and we get our net cash flow. So each month I can see almost as like with a P&L, but it's like a cash P&L. I'm saying, right, I'm 175 grand down in month one, but then I'm up and then I'm down, etc. And that's really important. But what's most important is this: is what impact does that have on your actual bank balance? Because this is going to be the difference between you being able to meet your obligations, pay your teams, pay your suppliers, or not. So you need to start with your opening bank balance as of when you're starting this forecast, and then apply that net cash flow movement to that opening balance to forecast where you think you're going to be. So I've just put a simple sort of condition on this to show me when things get within 50 grand and when things get below zero. So obviously, as you can see, I touched at the start, my closing bank balance is brilliant. It's 3 million quid. But I've got 3 months of the next 12 months due to the timing of me ramping up my production, due to some large capital expenditure and a corporation tax bill, etc. that I'm actually going to be in a minus. Now, like I said, next week I'm going to spend a bit of time on, well, what can you do about this? But at least this gets you to the stage of saying, right, this is where we need to spend some time and look into things. This is where I need to start making some decisions, changing some of the timings, or altering our decision making to make sure this doesn't happen, putting whether it's overdrafts in place or whatever it might be if it's a short-term thing. But if you know this now, you're in a far better position to manage these difficult stages because you know about them, basically. So that's it really in terms of a bit of a walkthrough of sort of a basic cash flow forecast and sort of how I'd go around it. Like I said, I totally appreciate that it doesn't apply to all businesses exactly like that, and yes, it was simplified in some areas, but hopefully there's a few principles there and a few bits you've been able to take away that you could apply to your own. I think the best thing to do now is open up to questions. So I don't know, Rachel, does anybody want to type any questions they've got into the Q&A, or you're more than happy to, if you think it's very particular to your own business, I'm more than happy to email me at gsmith@cameron.co.uk, and I'm happy to have a look.
Yeah, currently, George, we don't seem to have any questions at the moment on the live chat.
No questions on the live chat. Is there anybody got any on there? Just give it a minute. No, I think we're all right for questions. Like I said, I'm happy to speak to anyone, sort of share the sort of things that we're doing in our business around planning for this and some of the scenarios we're working through. So if there is anything where you think your business is very different to that and how I sort of go about it, I'm happy to have a conversation with you. So just do get in touch with us. Like I said, we do have a few points to make. Rachel's put together some videos on, depending on which accounts package you're using, with some just sort of useful tips and advice of how you might be able to get some of that starting information out, and some of the stuff that might support you with identifying, you know, that long list of outflows and stuff like that. So it should have come with the invite, but we'll reshare those links to those videos, depending on whether you use Opera, Exchequer, Sage, etc. And then next week I'm doing, you'll see on the invites we're sharing, I'm doing a session. Sort of now we've got to this position, we know where we have or haven't got problems, some of the practical things we could do around that, looking at things like stock management of lowering our stock balances to free up cash, how we can improve our credit control, options around financing and stuff like that. So almost covering the sort of practical, well, what do we do about this now sort of situation. So if there are no questions, I've just seen one popped in, Rach.
We have actually just had one. Do you reconcile your forecast back to the bank statement once the month end has passed?
I don't think you necessarily need to. It's never gonna match exactly unless what you want to do is at the end of the month put in your actuals. Rather than do that, I'd say what would be more useful is to reflect monthly on how accurate you're being. So I expected my bank balance to be £100,000. It's actually 50. Right, well, that's happened now. Why did it go wrong? Was it from sales point of view? Was it just the timing of a one-off? Was it because my costs aren't quite what I expected them to be? And then I'd look to see if there's anything I need to reflect or revise in the long term. So you know, it's never going to be spot on, but what I think you need to be doing on a monthly basis is absolutely reconciling and making sure it's similar, and updating your opening again. But it's really learning from, have I made a mistake here, or is something not happening? Or you might say, look, there was a one-off there, that just the timing that was brought forward a month or not, then that's fine. Yeah, let's reflect on that. But yeah, I'd sort of be reviewing it monthly and seeing if there's anything I need to change long term, rather than worrying too much about it being spot on every single month. Cool. Can I get a copy of your presentation? Yeah, I'm happy to send a copy of the presentation, and I'm happy to circulate that spreadsheet. All I will say is it is like an example working one, so please don't like use it perfectly to just to do your whole cash flow forecast on. But happy for you to have that just to try and edit it and build on it for your own. So I'll share the presentation on the spreadsheet. That's no problem.
And Helen's asked a question with regards to debtors reports, and the presentation we've put together. Helen will go through. It's a 10-minute video just on Pegasus on the reports that we would recommend running for these. So that'll be shared with you at the end of the presentation.
Yeah, and just as a really high level, quick way of getting some sort of expectation. If at the end of the month, say you do what your debtors are right now, so you're owed 100 grand. If you divide that by your sales for the month, and then times that by 30, it just gives you a really rough estimate of how long on average you're taking to collect your debtors. Or if you do it at your end of year, is probably the best actually. So do your last end of year or end of period debtors divided by your sales for that period times 365 if you're doing a full year's worth, then that'll give you a good debtors days basis. So like you said, you're probably thinking, well, we're celebrating our debtors days credit, so it should reflect that, but more often than not we find that not everyone pays exactly on time, so it might be creeping more to 45 days or 60 days. But yeah, as Rach said, there's going to be some specific videos on the reports to get things a bit more accurate than that high level one. Okay, I think is that all of them, Rach?
Yeah, that's everything. That's just a thank you. Right. So yeah, that looks like everything for questions, unless just final call for anybody else that has one before we end.
No, I think that's it. Yeah, great. Well, thanks ever so much, everyone. Like I said, hopefully maybe join some of you next week when we'll talk through some of the practicalities of what we can do with this information. I hope that was useful. I hope there was parts that you can take from that. And yeah, if you've got any other questions or want me to sort of chat through how you think you can apply it to your business, I'm more than happy to take a call or an email. Okay, thank you. George.